Everybody. So I wanted to do a little bit of an update here. We kind of hit the spots that I was talking about almost exactly over the last few weeks. I've been talking about MSTR, the weakness in the Bitcoin complex. We're not seeing as much of the weakness in Bitcoin itself, but that whole complex of other secondary and tertiary stocks have been coming down. We've seen a great degree of weakness in the miners. Quick reminder that we are not investment advisors and that anything we talk about today should not be construed as investment advice of any kind. It is for education, entertainment, and information purposes only. Please do not proceed if you are not in agreement with these conditions. And then, of course, MSTR, coin, and stocks like that. Hood kind of hanging in there, which I like. It's one of my favorite stocks, one of my big picks for this year, because I think it has that diversified revenue stream. It's very much crypto, but it's very much a whole bunch of other things. So I kind of like stocks in that area. Coin's interesting to me because it's transactional, although I think there's going to be competition coming. So there could be some pressure on margins there. But MSTR is kind of the topic of the day here. When the skew, we talked about this skew. So the zero line is right here, and anything below that zero line means that calls are more expensive than puts. We're talking short-term options here, 30-day options, and anything above the zero line means that puts are more expensive than calls. And typically in something like S&P in the SPY, you're going to see that all the time. You're going to see puts almost always more expensive than calls. So you'll see most of the time that it's going to spend time above the zero line. But in a product like MSTR, it's kind of the opposite, right? Because it's sort of whatever you want to call it, a flight to safety, a place to hide money. People want to own upside calls for that explosive potential. Gold is typically like that too. So it's a bit of an unusual animal. We have to remember that. This is not going to be your typical stock skew. But having said that, it often gets very, very expensive on the call side, the upside calls being very expensive versus the puts. And that usually shows a bit of a blow-off exhaustion top. So we saw that when we got to 500, 550, everyone got super, super bullish on the call side, and that was kind of the top. And so it hit the levels that we saw earlier in the year. So that was kind of a good sign that that was a bit of a blow-off top. I mean, it could have kept going, but the skew is saying that, okay, this might be a spot where it's going to, reverse down. And since then, we've sort of seen it gyrate a little bit. We got back to that zero line, but we were down in around here. And I said, you know what? I'm waiting for calls and puts to be very balanced. I want that pricing, that IV, basically to be very, very balanced before I start getting excited. Why is that? Well, because when this is more balanced, it means that people are piling into puts a little bit more. They're a little bit more worried about downside than upside. And for me, that's a contrarian signal that if people are suddenly throwing in the towel on something and getting a little bit more bearish, that could be a sign for me. And that's exactly what happened. I talked about us hitting that zero line. That's exactly what happened at the end of December. Boom, we hit it, zero line, and we pulled back a little bit. So for this particular indicator, that was a sign that maybe we hit that. And incredibly, that was actually, let's take a look here at the chart on this. Here's your MicroStrategy, came down, started to threaten closing that gap. And I put this out in a note on Twitter. I said, I think we could get down to maybe that 270 level, which would have been down around here. We didn't get there, but we almost closed this gap right here, and that was it. That was when the skew blew out. So that was what I was saying to wait for. Look for that little bit of panic in options markets to give you a signal that maybe this sell-off has been washed out. And now we're bouncing back, 313 right now. So what we did was we looked at 3 different kinds of strategies. And I'm going to show you those right now, ways that you can play this particular bounce right here. I'm seeing people selling covered calls out there on MSTR, and I'm going, what are you doing? I don't think there's a lot of edge in that. Doesn't mean the stock can't go down, and you will have been right in selling covered calls. But in my view, look at this is a stock that got into the high 100s in terms of implied volatility, and look what's happening. It's gotten crushed down to the low 90s. It's been absolutely annihilated. Here's your average implied vol for the year, up around 101, and here's your average skew for the year, your 52-week skew, kind of upside calls. See, this is what I was talking about. Typically, you get upside call buying and you get downside put selling, right? Because it's this sort of upside explosive potential type of instrument. And so this is typically what you'd see. And what I wanted to see was this skew blowing out a little bit to the downside. It's nothing extreme. It's not crazy like you would see in some areas of the market where people just kind of pile into those puts and it just gets crazy steep. But it is something to notice, right? We have to look at skew on the basis of what is relative for that particular name. Skew in gold is going to look very different from skew in S&P, is going to look very different from MSTR. So for MSTR, this represents more fear than is usual when you see that downside skew pick up. And that was the basis for my signal. And we hit it at the absolute closing low for the last 2 months, which is very interesting. So there are a couple ways that we can play this. So let's take a look. Two of those ways are going to be based on my thought that volatility's gotten a little bit too cheap. And I mentioned this a few weeks ago on a number of shows and in letters and in notes and in my videos saying, I think it's getting too cheap. I think the next move might be to go long volatility, right? So this is not an income trade. This is something that's going to take advantage of a couple of things. Directional potential, right? If MSTR explodes either to the upside or explodes down to the downside, we're going to get a directional move. We call that delta. So you're going to have a trade that has some delta in both directions. We're going to put on something called a strangle, which is what we did in the community actually. So, and that's starting to kick in a little bit today. We did that one a little bit earlier. The other two waited for that signal to kick in. So put on the strangle a little bit earlier. The other two waited for that signal to kick in, and then that's when those trades were structured. So in this case, one of the advantages to having a strangle at this point is number one, you've got that delta, which we just talked about. Number two, it's that you now own Vega. You have Vega exposure to a move. And what's going to happen? Well, let's take a look here. Here's your implied volatility in MSTR. Now this is short. This is 30-day, right? So this generally translates into the next couple months after that, which our trades are going to be in. They're going to be Febs and Marches, and the skew is going to be a slight bit different, and the volatility is going to be a slight bit different. But generally, you can translate those a little bit into those months, so no problem. We can look at these particular charts. So we have implied volatility dropping down into this very low level that we saw in early November. This is the blue line we're looking at. We saw implied volatility get as high as almost 200, 220 in fact, and we saw it get as low recently to the 100 level. And I said, that is just way too cheap. And on my other measure, it actually shows in the low 90s. That's very cheap for this product. When you're going along options, you have to be very careful. You cannot get in too early. You have to be particularly good with timing, or at least wait for the direction to start going for you before you do that. Because as we know, options are an eroding asset, and from the short side of things, you can be kind of wrong in a lot of ways and still do okay when you're short options. With long volatility, you kind of have to be right, and you have to be right fairly quickly. So there's a number of rules that you have to follow. It's a little bit more difficult to do, but you have that explosive leverage potential. And in this case, with volatility so low, I think if MSTR starts really getting going, I think it could get back to 375 to 400 fairly easily. What are we going to see? Well, again, remember I mentioned this is a different animal. This is not S&P. This is not Microsoft or Amazon or Google, although we're seeing interesting skew in those names as well lately. But this is not your typical thing. We could see an explosion of volatility. I think you could tack on 10, 15, 20 vol points easily, right? The implied volatility can explode higher. So not only with your strangler, you're going to get a directional move to the upside that can benefit you, because the one I've structured is actually long delta. It's skewed to the upside. It's not sort of neutral on movement. I've kind of skewed it to the upside because I think it has that potential to play catch up to where Bitcoin is. And we've had this big flush out. So the second benefit to having delta, which is going to make money as we go up, and we're going to do well as MSTR goes up, we're also going to get a potential explosion of volatility. No guarantees, but I think you could tack on 10 to 20 implied vol points in your position in this particular strangle, and you are going to get incredible Vega exposure. So let's take a look at that. Here's the trade that we did it at 64.95. It's already trading at 68.48. So we've already made $4 on this great move here. And part of that, I have to take a look into it. I don't know if there's still a little bit of vol pumping going on, but it might already be happening. But look at what we've got here. We've got positive delta of 38 on this one lot, and we've got positive vega of 98. What that means is you have that exposure to an expansion of volatility. You also have exposure to a contraction of volatility. So if volatility compresses, you could get a little bit hurt. But when you look at a trade like this, you're looking at implied volatility and going, you know what, I don't think it can get that much lower. It can probably drop maybe 5 points, worst case scenario, but my upside is maybe 10, 20, even 30 or 40 points. So that's kind of how you look at the risk reward there. Maybe it can drop 5 or 10, but it could very well go up 20 to 40 or 50 points. So there's your kind of risk reward, right? So it's not that there's no risk here. It's that I think it's gotten very, very low. And given what's happening over the next month with the new administration, with all kinds of things going on with rates and there's just so much up in the air that I think it's skewing to the upside in terms of owning volatility. So we could not only potentially make money on delta, we could potentially make money on a nice jump in vega. So let's take a look at our risk profile here. Here we go. So if we get a move up towards 400, we could make, let's say we even get to 375. I think that's very reasonable. We could make 3,800 bucks. But what we have to do is vol shock this. So let's add 10 points to this move, because if you don't take into account the move in volatility, then you're not really accounting for the possibility of volatility moving, right? So let's go 10 vol points. So suddenly from making 3,800 bucks at 395, let's say, let's go 375. Okay, so at 395, we were going to make 3,800 bucks, but with a 10-point vol jump, you're actually going to make an extra $1,600 on that jump. And that looks very, very interesting to me. That potential for that vega expansion, that implied volatility expansion. Look at this thing go. It's already jumping from that 290 level that we closed at a couple of days ago. We're already at 317. If we get a little bit of momentum, this thing could really go. No guarantees, but it could really go. Now, trade number 2. So strangle is one way to play it. Now, trade number 2 is going to be our pure income strategy. So what we did is we looked at Feb because I want a little bit of vega exposure, but the other way, right? I want just a little bit of potential for things to maybe calm down, but really this isn't so much about vega. In fact, I think if the stock goes up, the vega could hurt us a little bit on this trade, but this is more of a delta play, right? So if I go in there and I sell, and what we did was we sold the 230 at what was it, 11.25. 11.25. So at 11.20 it's already trading at 10 bucks, but let's take a look at what that looks like. It's basically just your cash secured put. That's how things are going to basically play from a pure income standpoint. And if this thing runs up, well, what we've got is a risk profile that looks like this. We're long delta because you're short a cash secured put. So of course you're long delta. You're going to benefit from an upside move in the underlying. And you're going to simply grab that $11 that's going to erode down to hopefully nothing. You probably want to close that up before expiry, but that's a way to just kind of extract a little bit out of this market that could potentially continue to go up. Especially if we start to see Bitcoin push over 100 grand. I thought maybe there's a chance we drop below 90, and we didn't. We held really steadily at that level, and we bounced up into the 96, 97,000 range. And I think that's really quite a positive for Bitcoin at this point. I wouldn't rule out a move back down into the low 80s or high 70s at this point, but right here, we're just putting this on for a trade. Now, what's another interesting trade that we can do? Well, we can sell this 230 put. And what we did is we sold the 230 put at 11.25. We bought the 330 call at $34. It's already trading at 39. Bought that one at $34. And then, so basically you've taken in $11.25. You've spent $34, right? So you've got an extra little bit of cash. That's an outlay of cash. So what I did was I sold the 360 for $25, right? So that's going to cut down the cost of this upside play, because what we're doing basically is we're selling a put to finance an upside call spread. And the downside put is going to take care of the cost of most of that upside call spread. So what you're doing is you're playing leverage, number one, right? You want the leverage that you get with an upside call spread. You're financing that with skew that's frankly a little bit steeper, right? We talked about that earlier. I showed you that puts have gotten a little bit more expensive than calls on a relative basis. And while I don't love selling really, really low levels of implied volatility, it's still pretty high. And if I use that as a financed play, I feel a little better about that, right? So I don't want to just make that $11. I want to make a bunch more because I think vol is low and I want to strap on some upside leverage. And I think this move could be very explosive. And any of you who've taken my programs, my courses, know that I hate to leave money on the table. I don't want to make $5 selling a put and leave $30 on the table if a stock really goes. So there will come a point in your trading where you start to learn this a little bit more. If you're in the programs or you're in the community, you're going to understand that there are times to really kind of push and press and potentially give up some of that income, but to be able to turn that into something really special. And we did that a number of times this year on all kinds of things. I did that 4 times on Amazon over the last 4 or 5 months, making money every single time on that. I call that a turbo trade. And did it on CLSK, did it on Meta, did it on a bunch of other cool things, Coin. So these are trades that can really, really add value when you think you're going to get that explosive move. And every single one, I think I had one trade that lost $2, but the rest of them made like 30, 40, $50, something like that. So, so you're basically going to sell that put to buy that upside call spread, the 330, 360. And let's take a look at what that looks like. Well, it looks like this, right? So we have to remember that when we sell that downside put, we are obligated to own MSTR below 230, before 200, below $230. So there's no question, you have to understand the risk here, unless you want to spread this off and buy a lower put, which can limit the downside, but you're not going to get as much of a credit, right? You're going to get a lot less money than if you just sell this put straight up. So you're going to sell this put, you're going to buy that upside call spread, and you're potentially going to make a whole bunch of money up here. If we get back up into the high 300s, you're going to turn this into a bit of a home run for the kind of trade that it is, right? You can make $3,000 on a one lot. That's pretty darn good for the risk that you put on for a couple months work. So those are the 3 trades we've got. We've got our strangle, which I positioned in March because I want a little bit more time and I want a little bit more Vega exposure for that expansion and volatility that could happen. You've got your upside turbo play that we put on here, that finance, I don't think it does right now, 10, 38, and 28. Yeah, it still does. It still pretty much finances the whole thing. So the whole thing is paid for by that short put. So that gives you a little bit of extra leverage, the potential to do a lot better than just selling that put. You're going to be able to make $30 instead of $10 if this works out. And then our final play is just simply the straight up simple income play, which is selling that downside put. And I think that's still okay. The vol's a little bit on the low side, but I think it's okay because the skew's really kicked up and we have other edge, right? Where we talked about it. We got that skew edge. We've got that chart edge. We've got Bitcoin around 100 grand still. So there's a bit of catch up to do, right? So we're bringing in all these sources of edge to bolster our theory. I would not sell a put at this vol level if I saw the chart falling off a cliff. That to me makes no sense at all. But once things start to kind of turn around as they are, as we look at this MSTR chart and we look at the overall picture, there are no guarantees that these trades are going to work out. But this is where we're starting to build that thesis that we could be in store for a little bit of a run to the upside, and all of these trades are going to do very well. So I hope you guys enjoyed that. 3 trades to make money on MSTR. And let me know what you think in the chat. And if you're interested in the community to learn more about stuff like this and be alerted when we do stuff like this, you can jump in very easily by reading the description below. Also, I have my Crush the Premium course available. I've got a New Year's Day sale on that. And I've also got a new live cohort starting in the next few weeks, which people are saying is unbelievable. I'm doing things they've never seen before. Somebody just gave me a testimonial yesterday that was absolutely fantastic. I'm so grateful for amazing testimonials. He said basically he's never done a testimonial for anyone and they've all asked for them. And he finally did one for me because he said it is off the chart, the gold standard in options training. So happy to hear stuff like that. So we'll see you guys in the next video.